That's the move that we suggest is now going to take you into the 90s, which is our interim level target. Just before, you might technically run the 3-digit, do a technical run and reject at the hundreds, somewhere in the hundreds. You'll pause there for a while. That's going to take a lot of people, a lot of getting used to, and industry and pricing. Think of what that does to solar panels in a lot of industries. And then again, you will surge through the 333 target, and I would expect a pause again there. Don't forget, that's a third of the way to 1,000. And we see 4 digits and single digit gold silver ratio as an overreaction to the downside on gold silver.
So if you want silver to get to its inflation adjusted high of 1980, it would have to trade $150. So there's your target. It's a good target, I think. Not tomorrow, but over time.
In this compelling market analysis, precious metals experts Francis Hunt and Vince Lanci discuss the explosive potential for silver prices in the coming months. According to Hunt, the current trajectory suggests silver could surge into the 90s as an interim target before potentially testing 3-digit levels. While a short-term pause is likely around these levels, the long-term outlook points toward much higher prices, reflecting the metal's inflation-adjusted highs from the 1980s. Hunt emphasizes that the industrial demand for silver, especially in sectors like solar panels and other high-tech industries, will significantly influence the price surge. Investors should understand that even though silver may experience temporary pauses at key technical levels such as 333, these are natural stages in a broader bull market pattern. The discussion also highlights the potential for silver to reach $150 if it follows its historical inflation-adjusted trajectory, reinforcing the massive upside potential for long-term investors. For those watching the precious metals market closely, this analysis provides clear insight into how silver could continue outperforming expectations. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates. And comment below to share your thoughts on it. Appreciate you for tuning in. Now listen to the interview. Now listen to the Yas.
The silver squeeze has yet to begin, really. The global silver market is tightening into a slow-motion short squeeze as physical supply vanishes, demand accelerates, and financial engineering replaces metal delivery, real metal delivery. Now, that sentence there, it sounds like something like, yeah, we knew that, right? But understand that when an industry or a person is under stress, they do what they've done before, just more. And so I don't really see, at least on the surface, to the extent that I can, the shorts in silver doing anything but delaying it more. And I'll say a little bit more about that. Silver's squeeze, in our opinion, hasn't started yet, but the setup is in place. So physical supply is vanishing. These are things we all know, but just put them all together. Physical supply in London is vanishing, right? While industrial demand, ETFs, and BRICS buying accelerate. Bullion banks are still rolling futures to defer delivery, turning a metal shortage into a balance sheet financialization potential problem, right? I mean, there's some big deliveries being taken, that's the word, but they're not all being taken. Some of them are being rolled. Look at how the open interest is rolling. Drops in one month, it goes up in another. They're kicking the can down the road. I'm not saying that's a bad thing. Well, it is a bad thing. But I'm saying that's, when your back's against the wall, you do what you've done to survive. And I think having been in that situation, I think they're just doing what they do because there's nothing else they can do. I'll give you an example. When you look at what's going on around silver, China pre-sold upstream supply. Silver cannot be leased like gold. If I'm a short of serious financial means, I have a lot of access to capital and serious physical market connections, and I can't get my physical anymore, well, I have two choices. I could default and say I don't have the silver, and I'm not going to do that because it would jeopardize my firm, which is much bigger than my little silver division. Or I could do what I've been doing, and that's double down. That's the martingale, right? All right, roll it. Hope they don't take delivery. If they take delivery, give them what they can and roll the rest. Keep deferring it. In a sense, they're financializing, well, not in a sense, they are. They're financializing the physical by rolling the shorts. And it's not just rolling the shorts. When you get into the physical delivery moments, someone will say, I want delivery. And if you're the short that has to make delivery, because that's what happens, gold has made an inflation-adjusted all-time high. So that's 1980. Here's 1980 gold, and here's gold today. So it's eclipsed its inflation-adjusted high. Silver is nowhere near it. It hasn't even gotten above its 2011 inflation-adjusted high. CPI adjusted, not necessarily real inflation. So if you want silver to get to its inflation-adjusted high of 1980, it would have to trade $150. So there's your target. It's a good target, I think. Not tomorrow, but over time. All right. There's the oil chart. I'm looking at oil and I'm saying this is a market being managed. I mean, I don't mean manipulated. I mean, this is a market with a lot of selling that's coming into it in an orderly fashion. I don't think they're worried about panicking the market. I think you've got the whole OPEC, US conversation going on, probably affecting things.
In this eye-opening analysis, financial expert Vince Lanci breaks down why the global silver market is on the verge of a historic squeeze. According to Hunt, the physical supply of silver is rapidly vanishing, while demand from industrial sectors, ETFs, and BRICS nations continues to accelerate. Despite this pressure, bullion banks and major shorts are using financial engineering, rolling futures contracts and deferring delivery, to delay a full-blown squeeze. Lanci emphasizes that the silver squeeze hasn't truly started yet, but the setup is fully in place. Physical supply in London is disappearing, while pre-sold upstream inventories in China limit leasing options. Shorts with significant financial backing are forced to either default, which could jeopardize their firms, or double down using strategies like the martingale to roll deliveries forward. The potential upside is substantial. Silver has yet to reach its inflation-adjusted 1980 high of $150 per ounce, highlighting the enormous long-term potential for investors. With historical parallels to past precious metal cycles and the ongoing structural tightening, silver could experience explosive price action once the market begins to release pent-up pressure. Let's get into the interview.
Yeah, I mean, I think pullbacks should be bought, depending on how deep your pockets are, right? Pullbacks can be bought as low as 54 and a half. Okay. But I'm not saying that I would do that. I'm not going to buy a pullback to 54 and a half. Why? Because I'm already long under 54 and a half for this speculative trade that I have. And so therefore, I'm not going to buy it again. But if you're looking for an entry, you would have to look for a pullback that gets near but doesn't violate 54 and a half. Or you can buy it here and go to an hourly chart and say, well, let me see. I'll buy it here, and as long as it doesn't get below 53.70, that's crazy. That's absolutely crazy. $4 in 3 days. I mean, it just blows me away. Now you're looking at this, I guess. I guess you're saying there's got to be buying in the 56 and a half area. And if you're bearish, if it cracks it, you think it's going to go to 53, 54 and a half, right? If you're bullish, if it gets near it, you buy it. So yeah, I like this. Here we go. Here's a range. This is a market that's digesting the movement to see if it's real. Here's a bigger range where you have real buying here and you have real selling here. This real selling hasn't been tested much yet, but this real buying has. So unless we break below 56.50, you would look for this to be retested in the next, say, 72 hours. Yeah, that's a spec trade. I mean, you want to risk $1 in silver? You might have to these days. The market's very volatile. Long at 57.45 with the stop loss below 56.50. Conversely, bearish, you sell weakness below 56.50. You reverse, right? Or you wait for it to get up here and you sell it and you stop yourself out up here because now you're really bearish and you're saying, I think the market can go all the way down to here.
These are your rejections at the 50 level, 1980, and then again at 2011. And then for us, you've been in a breakout since you broke that green line. Let me just remove some of my annotations. It's kind of a busy chart. So we said you'll probably get one more rejection, but it'll be very small. That rejection, in our opinion, is quite possibly happening, and it was very small. It's literally this. So I've gone from that 3-monther down to here. because of supply situation. So you are in a winding up for us HVF setup, which is a volatility squeeze. Most of the squeeze is from below.
In this detailed market analysis, financial trader Vince Lanci dives deep into silver's current volatility and trading patterns, revealing where opportunities may lie for short-term and speculative investors. According to Lanci, pullbacks in silver can be attractive buying points depending on risk tolerance and available capital. Key levels around 54.50 and 53.70 are critical for traders looking to enter positions without violating major support. Lanci explains that the market is digesting its recent rapid move, noting that $4 gains in just 3 days highlight extraordinary volatility. He identifies zones of real buying and selling pressure, emphasizing the importance of monitoring hourly charts to determine whether swings are sustainable. Traders can use stop-loss strategies near these levels to manage risk while participating in potential upside. The current market setup, characterized as an HVF volatility squeeze, indicates that most of the upward pressure is building from below. This suggests the market is winding up for a continuation move, making it essential for traders to carefully watch these technical levels for potential breakout opportunities. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.